Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribing, liking, and commenting underneath, because today we are tracking a company that went from a highly complex restructuring story to a $25 billion AI infrastructure titan seemingly overnight.
Yeah, it is honestly enough to give you whiplash.
It really is. I mean, just to set the stage for you, we are looking at a staggering 547% year-over-year revenue growth projected for 2025.
Which is just a phenomenal figure. And it's the perfect entry point for what we are doing today.
Right.
We want to look past the immediate hype of that booming stock price and really dissect the actual mechanics of this growth. Dig into the financials, the technology, and what it means to be a prime player in the neocloud supercycle.
Because you really can't talk about a 547% growth trajectory without talking about the absolute whale of a contract they just landed.
Oh, absolutely. The major catalyst.
Exactly. I'm talking about the March 2026 infrastructure agreement with Meta Platforms. And this isn't just a big deal. It is a $27 billion agreement.
Yeah.
It stands as literally one of the largest single compute procurement contracts in history.
And when you look at the structure of that contract, it paints a very clear picture of why the market reacted so violently.
How so?
Well, the deal is front-loaded. You have $12 billion in dedicated capacity, plus an option for up to $15 billion in additional capacity.
Wow, so that's a massive safety net.
It is. That structure provides an unparalleled level of revenue visibility for a company in this sector. Management is now targeting an annual recurring revenue like the baseline money they can count on coming in every year of $7 to $9 billion by the end of 2026.
And the analyst projections are forecasting roughly $4.8 billion in adjusted EBIT by 2028. And for those keeping track at home, EBIT stands for earnings before interest and taxes.
Right, basically a measure of core operational profit before all the financial structuring gets factored in.
Exactly. But I have to stop here because this is the part that melts my brain a little bit. How does a company just suddenly land a $27 billion contract from a giant like Meta?
It's a great question.
To me, it feels like, I don't know, like an indie band suddenly getting booked to headline the Super Bowl halftime show. And not just for 1 year, but for the next decade. How did they actually pull this off?
Well, we have to shift how we think about cloud computing to understand how Nebius secured this. Historically, if a company needed cloud storage or basic computing power, they went to the massive generalist hyperscalers.
Right, like traditional AWS, Google Cloud, or Microsoft Azure.
Exactly. You can think of those traditional cloud data centers like massive apartment buildings. They're designed to house thousands of different tenants, all using a relatively small, predictable amount of electricity and resources.
But generative AI entirely changed the physics of data centers.
Totally. Because it's not just storing a database of photos or, hosting a static website anymore.
Right, the computing power is on another level.
Far from it. Training massive language models requires linking thousands of highly advanced GPUs together to act as one giant synchronized brain. If traditional cloud computing is an apartment building, generative AI is like trying to put a heavy steel smelting plant inside that apartment building.
The electrical grids and the cooling systems would literally melt.
Exactly. The traditional hyperscalers, including Meta themselves, are facing severe internal capacity bottlenecks because their legacy infrastructure just isn't built for this.
Wow.
They cannot build and cool these specialized AI data centers fast enough to keep up with their own internal demands.
So Nebius isn't stepping in as just another software vendor to help them out. They are stepping in as an industrial developer.
Precisely.
They are building the heavy, specialized physical infrastructure, the smelting plants, to use your analogy, that Meta desperately needs just to keep its own AI models advancing.
That is the core dynamic. Nebius is a neocloud. That means they're a specialized cloud provider built from the ground up explicitly for the extreme power and cooling demands of artificial intelligence.
So they don't do standard web hosting?
No, not at all. They do high-density compute.
Okay, here's where it gets really interesting. Because the next natural question for you, the listener, is probably, why did Meta pick Nebius specifically out of all the emerging neoclouds?
It's a crucial question.
And it all comes down to a massive hardware moat. They aren't just buying off-the-shelf parts. Nebius secured early access to the cutting-edge NVIDIA Vera Rubin platform.
And that early access fundamentally changes their financial trajectory. Right now, most of the industry is still battling it out to secure current generation architectures like Hopper or Blackwell.
But Nebius is already moving past that.
Right. Nebius skipping ahead to the Rubin platform is a massive advantage for their unit economics because in this highly specialized space, you don't measure success by revenue per square foot of real estate. You measure it by revenue per megawatt of power.
And the research highlights how dramatic that leap in efficiency actually is. With the new Rubin GPUs, Nebius expects their revenue per 1 megawatt of power to increase to $17.7 million.
Which is incredible.
Yeah, especially when you compare that to the $11.6 million they were generating with previous generations.
To understand why that jump happens, you have to look at the mechanics of the hardware itself. The Rubin architecture is incredibly powerful, but to reach those speeds, it generates an immense amount of heat.
Right, thermodynamics always wins.
Exactly.
Yeah.
And if chips get too hot, they undergo thermal throttling. They literally slow themselves down to prevent melting.
Makes sense.
But by utilizing advanced liquid cooling systems designed specifically for these chips, Nebius allows the Rubin GPUs to run at maximum throttle constantly without overheating.
And that increased sustained output is what drives the revenue per megawatt from 11.6 million up to 17.7 million.
Oh, hit the nail on the head.
So they aren't just scaling up by adding more buildings, they are extracting drastically more financial value out of every single drop of electricity they pull from the grid.
Exactly.
Which leads us directly to the physical location of all this hardware. You can't just plug these liquid-cooled supercomputers into any municipal power grid, right?
No, definitely not.
That brings us to their planned AI factory campus in Finland. This location is slated to have up to 310 megawatts of capacity. But the standout detail here is the infrastructure itself. It's designed to be low carbon and features massive heat recycling technology.
Finland is highly strategic for them. The cold ambient climate naturally assists with the baseline cooling requirements, and the local grid is robust and heavily renewable.
That makes a lot of sense.
But the heat recycling aspect is what creates a long-term operational moat.
Yeah, I was reading about this, and it makes me think of a turbocharger in a car engine.
Oh, that's a good comparison.
Right. A turbocharger captures the hot exhaust gases that would normally just be wasted out the tailpipe and uses that energy to spin up the engine to create more power.
Exactly.
Nebius is doing something similar. They are taking the massive amount of heat generated by these servers, which normally requires even more electricity to vent and cool, and they are capturing it to warm local municipal heating networks. It essentially offsets their operational costs.
The upfront capital required to build that kind of highly engineered, liquid-cooled heat recycling system is immense. But the operational expenditure over a 10-year lifespan drops significantly.
Which is huge for margins.
Huge. In a landscape where every neocloud is trying to offer the most competitive compute rates to hyperscalers, having a structurally lower power and cooling bill gives Nebius incredible pricing power.
So they can offer a better rate to Meta and still maintain wider profit margins than a competitor who is paying a premium to cool servers in a less efficient facility.
Exactly.
That structural advantage makes sense, but I have to play the skeptic here for a second, because building 310 megawatt liquid-cooled AI factories in Finland and securing early access NVIDIA Rubin GPUs requires an unbelievable amount of capital.
It does. It's wildly expensive.
The plans outline an ambitious $16 to $20 billion CapEx planned capital expenditures just for the year 2026. And right now, Nebius is posting steep losses as it builds out all this capacity.
Right. But the current losses are an expected characteristic of the high-growth AI infrastructure sector. I mean, you have to buy the land, pour the concrete, and install the servers before you can rent them out.
Sure, I understand taking a loss during a build-out, but spending up to $20 billion in a single year? That is practically the size of their entire market cap.
It's aggressive, no doubt.
My concern isn't just the money, it's the sheer physical logistics. Even if you have the cash, sourcing that much copper, laying that much fiber optic cable, and physically deploying that many servers in 12 months without a major logistical collapse seems incredibly risky. Is this a house of cards waiting to fall over?
Well, the execution risk is the single most critical factor for this company, which we will touch on when we look at the market sentiment. But looking purely at the funding side, the balance sheet tells a story of aggressive, yet strategically de-risked scaling.
De-risked how?
Based on the late 2025 and early 2026 data, they had about $3.7 billion in cash on hand. And alongside that, they raised $4.33 billion in convertible bonds.
Right, and for those less familiar with corporate finance, a convertible bond is essentially a loan from investors that can be swapped for company stock down the line. It's a very common way for high-growth companies to raise a massive amount of cash quickly without immediately diluting the value of the shares currently on the market.
Exactly. But beyond the cash and the bonds, the structure of the Meta deal itself is acting as a funding mechanism.
Wait, really?
Yeah. This contract isn't just a promise from Meta to pay a monthly bill once the servers are turned on. It involves a massive prepayment model.
Oh, wow.
Meta is fronting a significant portion of the cash required to physically build the servers they intend to use. It operates like a tenant prepaying 5 years of rent, so the landlord has the cash to actually construct the apartment building.
That drastically reduces the reliance on high-cost external debt.
Exactly. They aren't going to the open market begging for $20 billion at punishingly high interest rates because Meta is underwriting the construction.
That changes the math completely. But there is another piece of the funding puzzle here, and it might be the crown jewel of their financial validation. A $2 billion direct investment from NVIDIA.
Well, that investment changes the entire narrative. $2 billion is obviously a tremendous amount of capital, but in this specific industry, capital from NVIDIA carries a weight that supersedes typical insider buying signals.
Because NVIDIA is the undisputed kingmaker here.
Exactly. They design and manufacture the GPUs that every single tech company on Earth is fighting to secure.
So for NVIDIA to take $2 billion of their own money and hand it directly to Nebius, that's not just an investment, that's an endorsement.
It is the ultimate industry stamp of approval. By investing directly, NVIDIA is signaling to the broader market that they have audited Nebius's engineering teams, their liquid cooling designs, and their thermal management strategies.
And concluded that they're the real deal.
Right. They concluded that Nebius is the optimal partner to deploy their most advanced, heat-intensive technology. NVIDIA needs showcases for the Vera Rubin platform to prove its capabilities. They are betting $2 billion that Nebius is the best company to build that showcase.
Okay, so what does this all mean for the actual stock and the market sentiment? Because the market has clearly caught wind of this underlying structure.
They absolutely have.
Looking at the price action, the stock is up nearly 400% in the last 12 months alone. It is absolutely crushing peers in the neocloud space. CoreWeave, for example, is up a very respectable 109%, but that is nowhere near 400%.
Investors have decisively shifted how they view the company. This is no longer seen as a speculative turnaround or a complex restructuring play. The market is pricing them as a validated blue-chip infrastructure titan.
Which is wild.
Yeah, I mean, the moment that Meta partnership was announced, shares jumped 15% almost immediately, pushing the market cap into the $25.2 to $25.8 billion range.
And we are also seeing incredibly aggressive dip buying momentum. The data shows a 30-day share price return of over 25%.
Which is very strong.
Yeah, it tells us that anytime the stock pulls back even slightly, institutional buyers are flooding in to scoop up shares, setting a very high floor for the stock. We're even seeing bullish analyst targets floating around $140.20 per share, which is heavily based on those 2028 operational profit forecasts we mentioned earlier.
Right.
But if you are listening to this and looking at the current valuation, you're probably noticing a glaring number. The trailing PE ratio, the price-to-earnings ratio, is sitting at over 163.
Yeah, a PE ratio of 163.47 should absolutely trigger alarm bells for anyone trained in traditional value investing.
Seriously.
When you see a number like that, it means investors are willing to pay over $163 today for every $1 of earnings the company generated over the past year.
Meaning you aren't buying the company for what it is doing right now. You are paying a massive premium based on the assumption that those 2026 and 2027 revenues are absolutely guaranteed.
Exactly.
Yeah.
The market has priced in absolute perfection. And that brings us back to your earlier point about the physical logistics of spending $20 billion in a single year.
The execution risks.
The execution risks here are monumental, and there is zero room for error built into that stock price.
Let's walk through that bear case. Because if you are priced for perfection, any slight delay becomes a massive liability. What happens if there are global supply chain disruptions for copper or specialized cooling pipes?
That's a real threat.
Or what if NVIDIA hits a manufacturing snag and the delivery of those Rubin GPUs is delayed by 6 months?
Or consider the infrastructure itself. What if the local power grid in Finland hits regulatory hurdles and they can't bring that massive 310-megawatt campus online on schedule?
Then the whole timeline shifts.
If any of those dominoes fall out of sequence, the company will be burning through their cash reserves without the incoming revenue from Meta to offset it. In that scenario, a PE ratio of 163 becomes completely unsustainable, and the stock could experience severe, violent downward volatility.
So the fundamental upside is clearly documented, the contracts are signed, and the funding is secured. But the physical execution of pouring the concrete, laying the fiber, and racking thousands of cutting-edge liquid-cooled servers without a single hitch, that is an incredibly precarious tightrope management has to walk.
It is the defining tension of high-growth tech investing right now.
Okay, so if we are trying to monitor the situation objectively, what does the catalyst calendar look like? What are the actual events over the next 3 to 12 months that will indicate whether they are walking that tightrope successfully or if they are starting to slip?
The most immediate event to watch is the Q1 2026 earnings release. Because the stock has run up 400%, a standard beat and raise on earnings might not be enough to satisfy the market.
Right.
Analysts are going to be intensely focused on capacity utilization rates.
Basically checking the receipts. Are the servers they've already plugged into the wall actually being rented out at full capacity, or is there idle downtime?
Exactly. They need to prove high utilization, and they will need to provide ironclad mathematical confirmation that the company is on track to hit that $7 to $9 billion annual recurring revenue target by year end.
And if they don't?
If management shows any hesitation or softening in that guidance, the market will punish the stock price severely.
Wow. And what should we be looking for beyond the quarterly earnings reports?
Pay close attention to the fallout from the post-March NVIDIA GTC conference. This is where the industry gathers to showcase new capabilities. We want to see if Nebius management signals any new hyperscaler contracts beyond Meta and Microsoft.
That would be a huge catalyst.
Huge. Securing commitments from other members of the Magnificent Seven tech giants would prove that the Meta deal wasn't a one-off fluke, but rather the beginning of an industry-wide shift toward their specific neocloud infrastructure.
It's also important to ground this in a realistic time frame for anyone tracking the space. The consensus is that this is a multi-year narrative. We are looking at a 12 to 24-month horizon for the real value to unlock.
The entire investment thesis relies heavily on the physical rollout of those Rubin GPUs in 2027. The true value creation, the massive cash flows required to justify a $25 billion market cap, will only be realized as these next-generation data centers are fully constructed, powered, and brought online.
Right.
It is a game of extreme patience, strict monitoring, and relentless physical execution.
So keeping an eye on these earnings calls and press releases isn't just about watching a ticker symbol bounce up and down on a screen. You are literally watching the physical architecture of the global AI revolution being built in real time.
That's a great way to put it.
You are tracking the concrete, the copper, the liquid cooling systems, and the silicon that will dictate who controls the next decade of enterprise technology.
It represents a fundamental shift in how global infrastructure is funded, engineered, and deployed.
It really does. So just to recap everything we've talked about today, we are looking at a dual reality. On one hand, Nebius Group is a fully validated titan in the neocloud space.
Absolutely.
They have the ultimate backing of NVIDIA's capital and Meta's $27 billion commitment. They have secured a technological moat with the Rubin architecture, and they are actively solving the most critical power and cooling bottlenecks in the generative AI space.
Yeah.
But on the other hand, they are facing the ultimate high-wire act. They have to physically execute up to $20 billion in infrastructure scaling in a single year while trading at a premium that demands absolute, unwavering perfection.
And as we wrap up our analysis today, I want to leave you with a broader, somewhat provocative thought to mull over.
Let's hear it.
We've firmly established that training and running advanced generative AI requires highly specialized neocloud factories, right? Cutting-edge liquid cooling and entirely different unit economics than traditional data centers.
Right.
If this trend continues, do traditional generalist cloud providers eventually become obsolete for high-end enterprise computing?
Yeah.
And perhaps more importantly, what does that mean for the massive tech giants who haven't yet locked in a decade of dedicated specialized capacity like Meta just did?
That is a massive question, and one that could completely reshape the hierarchy of the entire tech sector over the next few years. Thank you for joining us for the stock analysis, and keep exploring the rapid physical shifts happening in this incredible AI infrastructure space. We'll see you next time.